Hello traders, and welcome back to another In-Depth with Chris episode. Are you aware that there's something in place that controls the market in a way that if it moves too fast, too soon, it will shut it down? If you didn't know about that, chances are you're a newer trader or getting involved in trading, or perhaps you just really never gave it much thought. We're going to talk about velocity logic today, as well as dynamic circuit breakers, and it's important to be aware of them so you don't get caught off guard should one of these events happen. But without further ado, let's get going. The CME Group has several measures in place to deter extreme market moves. One such measure is velocity logic. By monitoring predefined parameters in futures markets, it helps prevent the market from making too extreme and fast movements over a given period. So with velocity logic, we can really look at it as a market integrity control measure deployed by the Chicago Mercantile Exchange, the CME. And the mechanism is intended to monitor futures price movements that would go too far and too fast. And the way that it does this is, once triggered, the velocity logic mechanism checks each arriving order against predefined upper and lower limits to ensure the price doesn't significantly exceed these limits within the given trading period. If the system determines that a potential trade will violate any velocity logic limits, VL high or VL low, the market will then enforce an immediate suspension in matching orders, effectively pausing trading. This sends the market into a reserved state until fair prices can be reestablished. The temporary halt in trading also allows market participants to reassess the situation and make trading decisions based on the current information rather than panic and immediately react. Now, it is worth noting that the suspension affects both futures and options markets. Simply put, velocity logic does impact us as traders, so it's naturally important to be acutely aware of how it works. So let's say that we are in a trading situation where we're trading a futures instrument that belongs to, metals, forex, equities, treasuries, or energy groups. Doesn't really matter, anything of the above. If a velocity logic event gets triggered, the entire group of related instruments is transitioned to its pre-open state. That means that the earliest possible market phase for the day. It allows traders to enter, modify, or cancel orders, but on the other hand, if the futures instrument doesn't belong to any of the groups mentioned above, only the particular market is transitioned into a reserved or pause state. Another thing to know is that when velocity logic comes into effect in the futures market, it also impacts the corresponding options market. If trading halts in a futures market, trading in the corresponding options market is going to also pause, and all mass quotes are canceled. You can use the time while trading is suspended to factor in recent information and make any necessary adjustments to your trading strategy or your particular game plan that you're trying to enact. Before the market returns to its active state, it will undergo indicative opening price verification. The process aims to determine an expanded price range to measure the potential indicative opening price values. If they fall within the newly expanded range, the market reopens and traders get notified of the indicative opening price to resume trading. However, if they fall outside the extended range, the market will remain in the reserve state and the system will perform another indicative opening price verification. This process will continue until the market falls within the price range. Furthermore, it is essential to note that the reserve state will remain in effect for a few seconds after the market reopens. In the corresponding options market, trading will resume after the velocity logic event in the futures market has been resolved. There is no indicative opening price. Instead, price discovery is determined by customer quote submissions. Velocity logic functions like a circuit breaker, though not necessarily in the traditional sense, of course. In trading, a circuit breaker is an emergency use market regulatory measure that temporarily halts trading on an exchange when prices exceed predefined levels. Upper and lower limits is generally what we refer to these places as. The circuit breaker kicks in if the security price moves too far away from these price bands. Its primary function is to prevent the implications of potential mass panic and follow-up market instabilities. There are 3 levels of circuit breakers in the stock market. The first is the 15-minute trading pause that triggers if a market sustains a 7% loss. A recent example of when a level 1 circuit breaker was triggered was when the S&P recently fell to 7% in March of 2020 following the COVID pandemic news. The second level is triggered when there is a 13% drop, resulting in trading being suspended for an additional 15 minutes. Level 3 is triggered when the market drops 20%, in which case trading is halted for the rest of the day. In contrast to traditional circuit breakers, velocity logic doesn't just check if the market movement has gone too far from predefined levels, but also if it has moved too fast. As such, it is possible for price movements to pass the band validation but fail the speed validation and in turn trigger a velocity logic event. Velocity logic was initially called dynamic circuit breakers, otherwise known as DCB. CME suggested it as an alternative to the 1-second minimum quote life recommended by the National Cattlemen's Beef Association, the NCBA. Now, the main difference between the traditional and dynamic circuit breakers is that DCBs move with the market throughout the day. Within specific time intervals, usually an hour, dynamic circuit breakers define an upper and lower limit within the instrument price can move. Moving past these limits triggers a DCB functionality. If the DCB is triggered in a lead month for the primary contract as designated by the GCC, all corresponding contract markets are immediately transitioned to a pre-open state. This usually lasts around 2 minutes with no monitoring period. On the flip side, if the DCB is triggered in a non-leading month, only the triggering instrument will transition to the reserve state itself. So some key takeaways. Velocity logic is a market control functionality that detects when the price of a traded futures instrument within a confined time interval exceeds set limits. When in effect, the velocity logic mechanism will suspend trading momentarily and the market is transitioned to a reserved state. If the instrument belongs to the energy, metals, equities, forex, or treasury groups, the entire group of related instruments traded on that exchange transitions into a pre-open state. Traders will receive a security status notification when velocity logic is in effect and will also be notified when the market reopens. So in short, velocity logic is our friend as traders. It's something that can help us keep the market a little bit more so under wraps, under control, and a little bit more predictable. If you're aware of how velocity logic works, then you can be prepared for when it's coming or when it's arrived. Until next time, thank you for joining me. I'll see you all very soon. Good luck and have fun on the other side.